Dear investor, while inflation does seem to have peaked out, central bankers are not letting their guard down. While increase in policy rates have slowed, central bankers are now expected to keep rates high for longer, and the peak rate could be a tad higher versus earlier expectations. This has caused a correction in the equity markets from the top. Markets which were buoyant in November on hopes of a policy pivot gave away some of their gains and consolidated. We had expected that. COVID fears resurfaced on spike in cases in China, and that also spooked sentiment. We had looked at valuations and pointed out that while market levels are sustainable, one should expect the market to consolidate in a range for some time, given that the bond yield to earning yield indicator was not favorably placed, meaning today at the current juncture maybe bonds offer better risk reward metrics. However, that said, equity markets are sustainable given that markets are trading at a near 10-year average valuations. Investors must note the changes in the indices in favor of quality businesses over time. Lower commodity prices help the India outlook. We have seen FPI outflows turning into inflows, practically coinciding with the drop in commodity prices. Commodity prices keep being soft, and that continues to help India outlook. Key worry has been sharply falling forex reserves. We see this as important and key to sustaining business as usual scenario in the country. Here, I think over the last 3 weeks, the manner in which we have seen a strong up move, some of these fears are getting addressed. Trade deficit has also dropped on a sequential basis. This has helped to address concerns for the time being, but we would keep this under watch. The improvement may prove temporary, as our growth rates are higher than that of the world, and Fed is increasing the pace of taper. The other key worry is of slowing global growth. However, today when oil production is constrained, lower global growth related slowdown in Indian economy. So, if globe let's say grows lesser by 1%, our exports as a percentage of our GDP is just about 18%. We lose let's say 18 bips of growth. Now that kind of growth loss gets compensated by the savings the country makes on lower oil prices. So today, we can't have both, high growth and low oil prices. So I think I am happy with the combination that we are getting. The third worry is resurgence in COVID. It's happening in China. The version is more virulent than what we have seen. But that said, experts are indicating that Indian population has developed a good immunity and we should not be impacted much. China is getting impacted more because of its zero COVID policy, which did not let the population getting exposed to earlier COVID variants. Over time, this may work in India's favor as global supply chains work harder on sourcing diversification. Next worry is to some extent reversal in Japanese carry trade. We have seen yen appreciating sharply over the last few days. Here again, I think impact on India should not be high, given that most of the incremental money into the market is that of Indian origin. Any event that causes a disruption in the domestic flows, confidence of the domestic investor would be a larger cause of worry. I think with positive policy momentum, that should not, the confidence should sustain. Going forward, margins should improve from Q3 onwards. Q3 season would start from middle of January. after 2 quarters when Indian manufacturing witnessed a margin squeeze on account of severe input price volatility and of course carry forward of inventory bought at higher prices. From Q3 onwards, it could reverse slowly first and then sharply afterwards. Amongst the growth sectors, cement, consumers to some extent, specialty chemicals and autos could see margin expansion. The period ahead may actually even see commodity margins expand as their inputs have also seen a reduction in price, and of course the government windfall taxation has reduced. H1 FY23 margin squeeze was led by commodities, and some reversal would be witnessed going forward. Ex commodities, EBITDA margins haven't fallen much. It's just about 1% in as yet in financial 23, and from this small dent they are expected to expand, making possibly the margin in financial 24 higher than or similar to what we saw in financial 22. EBITDA margin expansion would provide a tailwind to the earnings in financial 24. Banks dominated profit delivery in Q2 financial 23. There was a concern that these profits are peak profits and names could decline going forward. Also, credit growth may not be sustainable in the face of falling deposit growth. However, now with deposit growth picking up and with system liquidity improving, a higher growth rate can sustain for longer, aided by money multiplier. Most banks are comfortable on provisions, hence NPAs should not hurt, not as yet. PSU banks could see a sharper increase in NIMs given that their lending is linked to their own MCLR, which moves a tad behind repo. Actually, even NBFCs where the share of fixed rate loans are higher would benefit, as over time the loan book gets repriced. Amongst other spaces, tire companies, auto ancillaries should see margin expansion. In an economy facing the heat of global slowdown, margin expansion would prove to be a big driver of profit growth. So we made a point in terms of how much the India growth story can fall. And I think margin lever would provide the much needed tailwind in this scenario. Especially because margins are to be realized by cost going down rather than by producers having to increase prices. And hence we believe it's a good chance that they get realized. Lower commodity prices, better EBITDA margins going forward, and pre-election spends should help more than negate the negative influence of a global slowdown on profits. We continue to believe that it is time for alpha ideas. Better margins would sustain earnings. Spread margin bump up is mainly in the manufacturing part of value chain versus branding or distribution, while lower distribution costs would also provide earning support. Now, here the thought is that mid-cap and smaller companies derive most of their value from distribution and manufacturing and should benefit strongly. This implies continued strength in the earnings breadth and consequently with continued inflow of domestic money into markets directly or through funds, the chances of alpha seekers should improve. We are focused on quality, fast-growing businesses amongst, let's say, lenders, mainly banks, some NBFCs, chemicals, companies benefiting from domestic manufacturing renaissance, tech companies who may be on the verge of EBITDA break-even, for example, retailers, hospitals, and PLI beneficiaries looking at compounding of profits to deliver most of our returns. Sustaining performance is a very high and desired objective. We released as a house our 27th wealth creation study last month. The study pointed out that the consistent businesses have delivered much better risk-adjusted returns over the past 15 years, and even for sub-periods, this was true as compared to volatile businesses. Only the consistent businesses are investable for longer term, and that too if the consistency in performance remains. Other businesses must be looked upon as a trade. Our QGLP framework helps us identify such businesses. Going forward, we would incorporate the findings of this study in our risk framework. Besides other things, this should help sustain performance. Over and above the quality focus, we have laid out, for example, profit-taking frameworks, portfolio and stock sizing frameworks, sector weightages, deviations, and even stop-loss processes to help sustain performance once, of course, it is achieved. Outlook going forward, we are at the cusp of a new year. The new calendar year brings with it a lot of hope. While there are risks as well, as we have pointed out. Margin improvement is the key theme going forward and should work well in combination with other themes of calendar year 22. We expect a growth-oriented budget. This is the last full budget of the current government. Sustained growth and margin improvement in the country should keep the breadth of the market good. Valuations, as we noted, are sustainable, and investors should expect returns approximating earnings growth going forward, while the journey should be expected to be a tad more volatile. With this, happy investing and wish you all a very happy new year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.